ETFs. You've probably heard this term a lot when it comes to investing, but what exactly are ETFs? How do they differ from mutual funds? Are they the same thing? Should they be part of your portfolio? So in this video, I'm going to explain exactly what an ETF is and how you should be thinking about the answers to those questions. Hey guys, Jessica here. Before jumping into it, really quick call out that we're Uprise. We're a VC-backed fintech company that is building the best financial plan experience in the world. One number, 1.5 million. That is how much, on average, we've been able to find and add back to customers' lifetime net worth. And the way we do this is by looking at people's specific situations and then finding optimizations. So everything from looking at employer benefits to paying down debt to optimizing credit cards and everything in between. All of the plans that we put together are personalized, Wall Street level, and completely free. So to get your plan, definitely check us out. I've linked to us in the description below. And also, if you get value out of this video, please give us a thumbs up, hit that subscribe button. It really, really helps small channels like ours. Getting back to it, ETFs, this is how I'm gonna break down the video today. So the first part I'm gonna cover is the basics, like what ETFs are, how they work. The second part is the different types of ETFs that are out there. The third part is sort of pros and cons, how to think about the pros and cons of ETFs. And the last piece is, I'm sure, what everybody's thinking about. What is the difference between an ETF and a mutual fund? As always, I have to say it, ETFs are related to investing. And as with anything related to investing, there is risk involved. So before you do anything, just make sure that you understand and feel comfortable before making any investment. Okay, so the basics. ETF stands for Exchange Traded Fund. And they've really been taking off over the last 20 years. They've been super popular investments. In the last year, in 2021, ETFs represented $10 trillion of investments. That is how large they are. And they continue to be the fastest growing asset class out there. In terms of how they work, think about it this way. Suppose you go out and you buy Apple stock. So you buy one share of Apple. And then after you buy that share, you would own one share of Apple. But if you go out and you buy one share in an ETF, then you would actually own pieces of, say, 50 different companies at the same time. And the reason for this is that an ETF is a fund that houses a collection of assets. So stocks, bonds, whatever the ETF is focused on. And so when you buy an ETF, you're essentially buying a piece of or a percentage of all of the different companies or assets in that fund. And on top of that, even though an ETF is a fund, right, that houses a collection of assets, you can actually trade this fund, this ETF, on an exchange as well. Hence the name, Exchange Traded Fund. Get it? This is one of the major ways it's different from a mutual fund, but more on that later. Okay, so then different types of ETFs. There are tons of ETFs out there, and generally each ETF will focus on something. So maybe it'll focus just on stocks or just on bonds, something like that. Some of the most popular categories for ETFs would be things like stock indexes. So for example, you've heard that maybe there's an ETF tracking the S&P 500 index. Other categories, for example, say dividend stocks. So these would be stocks that generate dividends. And maybe this ETF houses only dividend stocks. By the way, we did a separate video that talks about what dividend stocks are. You can check that out up here. Other than that, maybe you have an ETF focused on a specific geography or specific industry. Those are examples of the different types of ETFs out there. The main point here, by the way, is that there are infinite ways to sort of set up ETFs. And at the end of the day, this is a lot of what like the financial services companies do is kind of like get a sense for what people want to invest in. And then they structure their products to match that. Okay, pros and cons, starting with pros. The main one, the biggest one, is diversification. You may have heard of this already, which is basically when you think about putting together a portfolio when you're investing, you want to not put all of your eggs in one basket. You want to spread out your investment across 100 different stocks or 1,000 different stocks. And investing in an ETF allows you to get instant diversification, which leads me to the second point, which is ETFs really help keep things simple. Because imagine a world without ETFs or mutual funds and stuff like that. You would literally, in order to implement diversification, you would literally need to have a portfolio of like 100 different stocks or bonds or whatever. And keeping track of every single one of those, keeping track of like gains, losses, dividends, whatever, taxes, it's just a really big pain in the ass. And being able to just track one ETF, one investment, is just a lot easier. ETFs are also low priced. For what you get, the pros and the benefits of it, they're actually very affordable. And the way ETF fees work is that the fees are called expense ratios. It basically just means fee. It's a percentage of the total amount that you have invested in the ETF. And the reason why ETF fees are so low is because many of them are passively managed. They just track an index. And so there's not a lot of like manual changing things around. And as a result, you can find ETFs, say, in the range of 0.1%, or even lower than that. And lastly, taxes. They're very tax efficient. I won't go into too much detail on this, but basically ETFs don't throw off a ton of cash unless specifically you're looking for an ETF that does that. But most ETFs don't. And so as a result, they're pretty tax efficient. The biggest con of ETFs, and maybe my only con of the ETF, is that as with anything that you buy, you need to make sure you know what you're buying. Meaning, like, just because ETFs as a category is great, that doesn't mean that each individual ETF is good, right? Like, I'll give you an example. So for example, an ETF that tracks the S&P 500, there are actually like a ton of these ETFs out there. They all do exactly the same thing, track the S&P 500, and yet some of them are way more expensive, say 0.2% fee versus 0.03% fee. And it doesn't make any sense why there is a difference in the fee if they do the exact same thing. So this is the kind of thing that I mean, which is like when you are looking at investments, make sure you shop around, make sure you're getting a good deal. Along those lines, some ETFs may claim, for example, to have a lot of exposure to a certain thing. So say you wanted to have exposure to Japan in your portfolio. And so you find an ETF that says they have exposure to Japan. It's still worthwhile to actually then go into and like look into the documents of that ETF to see what exactly they're invested in. So for example, even if they invest in Japanese companies, maybe these are like global Japanese companies like Nissan or whatever that has like very little domestic Japanese presence and actually is mostly globally exposed, in which case then you didn't really achieve your objective of exposure to Japan. So these are the kinds of things I mean when I say that it's worthwhile not just to take things based on surface level. You should look into the fees, you should look into what they're invested in, make sure you understand and are comfortable before investing. Okay, and lastly, ETFs versus mutual funds. They're actually super similar, which is why this is a very common question, in the sense that like an ETF and a mutual fund, both of them allow you to invest in a basket of different assets with just one investment. But there are very key differences, and ETFs have actually been emerging as a winner over the last 10 years, and this is why. For one, cost. So ETFs are on average cheaper. But again, all ETFs are different, all mutual funds are different, worthwhile to compare prices. But on average, across the board, ETFs are generally cheaper. So related to that, commission fees. Mutual funds sometimes have commission fees if you wanted to buy into the fund or if you wanted to sell out of the fund. So definitely watch out for those. ETFs generally don't have these fees because they're traded on exchanges. So as long as you're using a major brokerage like Robinhood or Fidelity or whatever, it's generally free to trade, to buy and sell. Another thing is minimums. So sometimes mutual funds have minimums. Say you need to be investing a minimum of $1,000 or $2,000 into this fund in order to get access. ETFs don't have this, meaning like if you're going to a brokerage like Robinhood, etc., you can buy even a fraction of a share of an ETF, I think for as little as $1. Along those lines, trading. So ETFs are really easy to buy and sell, whenever the exchange is open, whereas mutual funds, you have to wait until after the markets close in order to make a trade. And lastly, management style. So a lot of mutual funds can be both active and passive. Passive meaning they track some index, active meaning they're actively picking stocks and this kind of stuff. Generally speaking, passively managed funds are cheaper than actively managed ones. So ETFs in general are more likely to be passively managed versus mutual funds are more likely to be actively managed. Hence, ETFs are cheaper. And that's it. Those are my thoughts on ETFs. I hope that was helpful. Definitely, if you have any questions or comments, let us know below. And one last thing to call out, just reiterating again, ETFs and mutual funds and anything else related to investing, just make sure you understand what's going on, that you're comfortable with the investment, you understand the risks before pulling that trigger. Also, if you'd like more support with personal finance, definitely check out Uprise, as I mentioned before. The link's in the description below. We put together personalized Wall Street level financial plans completely and 100% for free. So any questions around getting started investing, thinking about employer benefits, budgeting, whatever it is, we'd be happy to help. And on average, we found $1.5 million to add back into customers' lifetime net worth. Other than that, if you got value out of this video, please give us a thumbs up, hit that subscribe button, and click the bell for notifications. See you guys next time.